Good morning, Andrew Benioff with Lenrock Group and the Lenrock blog. Today I am pleased to have with me Pat Brala, the Senior Vice President and Chief Financial Officer for Keystone Property Group, a private equity real estate firm based here in the Philadelphia suburbs. As Chief Financial Officer of Keystone, Pat oversees all accounting, finance, and investor relation activities, as well as debt financing and relationships there. Prior to joining Keystone, Pat also held the Chief Financial Officer position at AMC Delancey Group and had positions with Keating Development and Price Waterhouse prior to that. Pat, thank you very much for joining us today.
Thanks for having me.
Wonderful. Let's talk a little bit about CMBS debt and what you see in the CMBS market. Are you seeing a return of availability for CMBS? And if so, has Keystone been able to take advantage of that, and in what way?
Sure. Well, we have certainly seen a return of CMBS debt market, and we've been really able to take advantage of it. Over the last 12 months, we've probably financed well over $100 million in CMBS debt just in the last 12 months alone. And for us, it's worked out really well because strategically, we've been looking to shed some of our recourse, and but at the same time, it's allowed us to monetize the assets at good valuations especially in situations where we may want to hold that asset for just a little longer. And we've seen loan to values in the 75 to 80% range, and interest rates in the 4 to 5% range.
And that 75 to 80% has been for, I know your focus at Keystone is suburban office and that value-add turnaround type of suburban office. That's been mostly for that type of product?
That's right. For CMBS, it's our stabilized assets. It's assets not necessarily where there's a lot of value add left.
Got it. But that seems like a pretty good LTV for those type of assets.
That's right. That's right. It's worked out very well.
So they're getting more aggressive, it sounds like to me.
Absolutely.
Wonderful. Okay. As a significant borrower of debt capital, how have recent changes in banking regulations and lender requirements affected the company? And has this affected your role in the company as well? Made you busier?
Yeah, unfortunately, this has been an area where we've just been an area where lenders have really changed both their reporting requirements and also their cash management requirements over the last several years, and which has really caused us a lot of more allocation of accounting and administrative resources. There's just more lock boxes, more escrow accounts, more compliance reporting, more forms to fill out, and cash management waterfalls. So it's something that has really had to shift resources inside. And as far as my role is concerned, I found myself really having to play more of a role in the compliance aspect.
Wonderful. And do you see this change as, is this a change from sort of version 1 of CMBS up until, say, 2007, 2008, as compared to today? Is that where you see this?
Absolutely. I think it's a change a little too far. It's also actually, we have to really take that into consideration because the resources that are needed to do this, it's not something we were necessarily used to in the past.
They often say that the pendulum swings a little too far the other way.
It has swung a long way.
Do you feel like it's going to come back to the center eventually, or closer to the center?
I'm not sure yet. Not sure. We certainly haven't seen a change yet.
Okay, interesting.